This is Jody Trana with Chapter 5, Part 3 of Principles of Accounting. There are two systems to keep track of inventory. The perpetual system is what we've been working on throughout this chapter. It keeps a running total in an account called merchandise inventory. Every time we purchase or every time we sell, we adjust our merchandise inventory account. Perpetual inventory systems are used by most companies today, but sometimes they are too expensive for smaller businesses. That's where the periodic inventory system comes in. The periodic inventory system requires physical counting of inventory to determine how much is on hand. The merchandise inventory account is still used, but it's only updated at the end of each period. Depending on the company, that could be the end of the month or the end of the year during a closing process. Accounts 1 through 5 are the new accounts that we added when we changed our company from a service company to a merchandising company. The primary change in accounts for companies using the periodic inventory system is that the cost of goods sold account is not used, and instead we use these accounts: purchases, purchase discounts, purchase returns and allowances, and freight in. Let's go back to our tried and true Smart Touch Learning example. Remember, on June 1, we purchased $35,000 worth of tablets from Southwest Electronics Direct. Let's look at these transactions again, but this time we're going to look at them as if we use the periodic inventory method. Let's say on June 3, Smart Touch Learning receives the merchandise inventory that they purchased on account. What is the journal entry that you would use for this? And remember, you cannot use merchandise inventory. This time we're using our new account called Purchases to record the debit of $35,000 for the inventory that we received. The accounts payable account stays the same as our credit. Let's take another look at the accounts that we're going to use in the periodic inventory method. Purchases, which we just used, purchase returns and allowances, purchase discounts, and freight in. Now let's record the payment that we made on June 15 that is within the discount period. We're still using the periodic inventory system. Instead of reducing the cost of our merchandise inventory directly into the merchandise inventory account, we will use an account called Purchase Discounts. Our credit for the discount we're taking will go into that account, and we will use it later to net out our purchases. We're recording our debit to accounts payable and our cash as a credit. Think about how a return would be posted. Remember that Smart Touch Learning returned $7,000 worth of inventory to the vendor. We reduce our accounts payable amount with a debit of $7,000, and a $7,000 credit goes to purchase returns and allowances. Finally, when Smart Touch Learning pays for a freight charge, we need to record that, and before we would have recorded it as an additional charge in merchandise inventory. Now we have a special account for freight in. The journal entry would be freight in for a debit of $60 and cash for a credit of $60. Here you can see a graphic that shows all of the journal entries on the left that we've been practicing up until this point. On the right, we have the periodic inventory system that includes the account that we just reviewed, the purchases account, purchase returns and allowances, freight in, and purchase discounts. There is some good news. The journal entries for making sales are much easier with the periodic inventory method. Because we do not need to keep a running tally in our merchandise inventory account, we have fewer journal entries. When we make a sale, we only need to record that accounts receivable and sales revenue. And when we receive goods that are returned to us, we just need to reverse that accounts receivable and post it to sales returns and allowances. We do not adjust for inventory shrinkage because with the periodic inventory method, we're going to do a physical count and do that adjustment at the closing. Let's talk about the closing process for a merchandising company using the periodic inventory system. As with all of our closing processes, we need to close all of the temporary accounts. You can see here the accounts in blue are the new accounts that we have with the periodic inventory system: purchases, purchase returns and allowances, purchase discounts, and freight in. Here's a quick review on the four-step process to closing the accounts of a company. Our first step was to close revenues. Second step, close expenses. Third step, close the income summary into capital. And fourth step, close the owner withdrawal into capital. We're going to make a few slight adjustments to this four-step process for the periodic inventory method. First of all, we need to think about not just closing revenues, but closing every temporary account that has a normal credit balance. Along with that, we're going to include the new merchandise inventory ending balance. We'll talk about that in a minute. The second step will not be just to close expenses, but to close all temporary debit balance accounts into the income summary account. And to that, we're also going to include the old merchandise inventory beginning balance. Again, we'll talk about that in a minute. Third has not changed. We close the income summary into capital. And fourth, we close withdrawals into capital. Let's take a look at what we're trying to accomplish when we close out merchandise inventory at the end of a period. Here we have a balance in merchandise inventory of $14,300. We say that it's December 31, but it's the same amount as it was on December 1. We need to make our closing adjustment to merchandise inventory to have it reflect the accurate balance of what we actually have on hand to sell. Because $14,300 was the balance that we had at the beginning of the month, we need to clear that amount out. We're going to credit merchandise inventory and debit income summary in order to move that merchandise inventory out of the account. With the periodic inventory method, the company needs to do a physical count of inventory, which we're going to say that they have completed and have found that there is $18,500 now in merchandise inventory. So we have cleaned out that old account balance of $14,300 by crediting the account. Now we can debit the account with the new balance of $18,500 and credit income summary for the same amount. By doing this, you can see that we have cleared out the merchandise inventory balance of $14,300 and have reestablished a new merchandise inventory balance of $18,500. This will be our new merchandise inventory balance for the next accounting period. The adjustments that we've made to the merchandise inventory account and the income summary account don't actually appear like this on a journal entry. We're going to include these adjustments within our 4-step closing process. Here's an example of some closing journal entries for D&L printing supplies. D&L printing supplies uses the periodic inventory method, and you can see that they have the accounts that we've just learned about: purchase returns and allowances, purchase discounts, purchases, and it looks like we don't have a freight in with this company. It's very interesting to note that with a periodic inventory system, we do not have to make an adjustment for shrinkage in our inventory like we do with the perpetual inventory method. That's because with the periodic inventory method, we naturally do a count at the end of the period in order to adjust for our merchandise inventory. You'll see here that the beginning merchandise inventory account is credited and the ending merchandise inventory is debited. So let's talk about that. Merchandise inventory is an asset account. An asset account has a normal debit balance. So our previous balance in the merchandise inventory account was $122,000. In our closing process, we need to take that number out, and in order to take it out, we credit it. That will reduce our merchandise inventory account to 0. Then we debit the merchandise inventory account for $99,500, and that establishes our new merchandise inventory account for the next period. But where did that $99,500 come from? It came from a physical count that the company did to identify exactly how much inventory they actually have. So with a periodic inventory method, each month the inventory is counted and we just zero out the balance and add in a new balance to identify how much there actually is. Hopefully you can see that the net effect between crediting the merchandise inventory account for the entire balance and debiting the merchandise inventory account for the new balance will affect our capital in the same way that the cost of goods sold would.